Imagine you bought a stock at $80. It drops to $60. You hold, it drops to $40. You hold, it drops to $22, and you still hold. Not because you believe in the company, not because you've done the research, not because any rational part of your brain is telling you this is a good idea. You hold because you paid $80, because somewhere in the back of your mind, you believe that selling now would make the loss real, that as long as you are still holding, there is still a chance that if you just wait long enough, the stock will come back, the math will reverse, and you'll be vindicated. You hold because you can't let go. This is the sunk cost fallacy, and it is one of the most quietly devastating forces in all of personal finance. Today, we're going inside the psychology of why smart people hold on to bad investments. Not because they're stupid, not because they're weak, but because the human brain is wired at a deep and almost unbreakable level to chase what it has already lost. Before we get into the psychology, we need to get precise about what a sunk cost actually is. A sunk cost is any resource, money, time, energy, emotion that has already been spent and cannot be recovered. It is gone. It is done. No future decision you make will change the fact that it happened. In pure economic theory, sunk costs should be completely irrelevant to every decision you make going forward. If you are deciding what to do tomorrow, yesterday's losses are not data. They're history. And yet, we treat them as data, all of us, constantly. A restaurant opens. It loses money for 2 years. The owners know, rationally, that the business isn't working, but they've already invested their savings, they've already quit their jobs, they've already told their family this was going to work, so they keep going, month after month, loss after loss. Not because the future looks bright, but because the past feels too heavy to abandon. That is sunk cost thinking in its purest form. And in the stock market, where every single day you can see in bright red numbers exactly how much you've lost, it is absolutely everywhere. Here is where it gets fascinating and a little unsettling. Neuroscientists have studied what happens in the brain when we lose money, and the results are striking. Financial loss activates the same regions of the brain as physical pain: the anterior insula, the amygdala, the same circuits that fire when you burn your hand on a stove. Those same circuits light up when you watch your portfolio drop. And just like physical pain, the brain's first instinct is to make it stop. But here is the trap. When you are holding a losing investment, you can't make the pain stop by selling locks in the loss. It makes it final. It transforms the number on a screen into a real, permanent, undeniable fact. So instead, the brain does something else. It holds on, it waits. It generates hope, artificial, irrational, neurologically manufactured hope that the loss will reverse and the pain will go away on its own. Psychologists call this loss aversion. We covered this concept briefly in our last video on panic selling, but here it works in the opposite direction. Where panic selling makes you act too fast, loss aversion makes you freeze. It makes you unable to move, unable to cut, unable to do the one rational thing the situation is calling for. Because cutting the loss doesn't feel like a rational decision. It feels like surrender. It feels like death. There is a story that behavioral economists love to tell when they explain the sunk cost fallacy. It is called the Concorde Fallacy. The Concorde was a supersonic passenger jet, a joint project between the British and French governments beginning in the 1960s. The plane was an engineering marvel. It could cross the Atlantic in under 3.5 hours. It was also, almost immediately, a financial disaster. The costs were astronomical. The economics never worked. By the time the project was well underway, both governments had clear evidence that the Concorde would never be commercially viable. It would never pay for itself. It would never generate the returns they had projected, and yet they kept going for decades, pouring money into a project that every rational analysis said was already a failure. Why? Because they had already spent so much. Because stopping felt like admitting that all those billions were wasted. Stopping felt like losing. And so they kept going not toward a profitable future, but away from a painful past. This is why the sunk cost fallacy is sometimes called the Concorde Fallacy. Because the people making these decisions weren't irrational in any global sense. They were intelligent, experienced people. But they had fallen into a trap that the human brain builds for itself, the trap of trying to justify the past by doubling down on the future. We do this with stocks every single day. Let's make this concrete in portfolio terms, because the sunk cost fallacy doesn't just show up in one pattern. It shows up in several, and most investors don't recognize any of them. Pattern 1, the averaging down spiral, the stock drops 20%. You buy more, maybe that is reasonable. It drops another 20%. You buy more, again. It drops another 30%. Now you are fully committed. You've tripled your position in something that has been consistently moving against you. Not because the fundamentals support it, but because you need the math to work. You need a smaller loss to average your way into. You are not investing anymore. You are negotiating with your own regret. Pattern 2, the I'll sell when I break even rule. This one is so common, it almost sounds sensible. You buy at $100, the stock drops to $60. You tell yourself you'll hold until it gets back to $100, and then you'll sell. But think about what that logic actually requires. It requires the stock to rise 67% just to get you back to zero. And it requires you to believe that a stock that has already lost 40% of its value is the best use of that capital, going forward better than any other investment available to you, simply because of the price you paid. The price you paid is not a reason to hold. It never has been. Pattern 3, the emotional attachment trap. Sometimes the sunk cost isn't even primarily financial. Sometimes an investor has talked about a stock publicly, posted about it, recommended it to a friend, built an identity around being right about this company. Now, selling isn't just a financial decision, it is a social one. It means admitting publicly that they were wrong. And so they hold and hold and hold and hold until the loss is so large that even the pride of being right someday can't justify it. There is a cost to the sunk cost fallacy that most people never calculate. It is called opportunity cost, and it might be more damaging than the loss itself. Every dollar you have sitting in a losing position is a dollar that is not sitting in a winning one. Let's say you have $10,000 in a stock that is down 50%. You are now holding $5,000 of original capital, but you are telling yourself, while you wait, the broader market returns 10% annually. The S&P 500 compounds quietly in the background. Other sectors recover. New opportunities emerge. And your $5,000, your frozen sunk cost, trapped $5,000, sits in something that is not moving or moving in the wrong direction, while the rest of the market moves without you. Time is not neutral. Capital sitting in the wrong place has a cost, and that cost compounds every single day you refuse to make a clear-eyed decision about where your money actually belongs. The question is never, how do I get back to even? The question is always given where I am right now. With the money I have right now, what is the best possible use of this capital going forward? If you can honestly answer that question, and your current position is still the answer, hold it. But if the honest answer is something else, the price you paid is not a reason to stay. There is a reason this is so hard to actually do in practice, and it goes deeper than just losing money. Behavioral economists have identified something called anticipated regret, the pain we feel not just from what happened, but from what we imagine we'll feel about it later. When an investor sells a losing stock, and that stock subsequently recovers, even partially, the regret can be overwhelming. I sold at the bottom. I should have held. I gave up too soon. That specific, searing version of regret is so psychologically painful that investors will go to extraordinary lengths to avoid experiencing it. And so they hold on, not because they believe in the stock, not because the numbers make sense, but because they are afraid of how they'll feel if they sell and then watch it recover without them. This is the sunk cost fallacy in its most insidious form. It is not just about the past. It is about protecting yourself from a future version of regret. The problem is that regret runs in both directions. If you hold and the stock continues to fall, you will also feel regret, deep, devastating, compounding regret. But that second version of regret feels more abstract right now. It exists in an imagined future. The regret of selling too early feels more vivid, more certain, more threatening. And so the brain chooses the comfortable illusion over the rational decision every single time. So is there a way out? Is there a way to make decisions that the sunk cost fallacy can't corrupt? There is, but it requires deliberately thinking in ways that are unnatural. Rule 1. Ask the replacement question. Every time you are evaluating a holding, ask yourself this: if I didn't own this position, if I had fresh cash in my account right now, would I buy this stock today, at today's price? If the answer is yes, hold it. You are making a real argument for its future, independent of its past. If the answer is no, then the only reason you are holding it is because you already own it. and that is a sunk cost. This question forces your brain to evaluate the future on its own terms, without the gravitational pull of what you've already spent. Rule 2. Separate the decision from the result. Good decisions can produce bad. This is an uncomfortable truth, but it is the truth. If you sell a losing position and it subsequently recovers, that does not mean your decision was wrong. You made a decision based on the available information, the opportunity cost, and a clear-eyed reading of the situation. The outcome doesn't retroactively change the quality of the thinking. Training yourself to evaluate your decisions independently from their outcomes is one of the most powerful things you can do as an investor. It makes you immune to hindsight bias, and it makes the next decision easier to make clearly. Rule 3. Pre-commit your exit before you enter a position. Decide when you will exit it and under what conditions. Write it down. Set an alert. Make it a rule, not a feeling, because in the moment of a loss, you will not be thinking clearly. The pain will be real. The sunk cost pressure will be real. Your ability to reason without emotional distortion will be severely compromised. The version of you that entered the trade with a clear head is smarter than the version of you sitting in a 40% loss at 11 p.m. Let that version make the rules. Then follow them. The sunk cost fallacy isn't just a trading problem, it is a human problem. And understanding it changes how you see decisions in every area of your life. The person staying in the wrong career because of the years they've already put in sunk cost. The person staying in the wrong relationship because of the history they've built together, sunk cost. The person finishing the book they hate, sitting through the movie they're not enjoying, eating the meal they don't want because they paid for it, sunk cost. In each of these cases, the past is being allowed to hold the future hostage, and the tragedy is that it doesn't have to. The past is fixed. The future is not. Every single day, you get to make new decisions about what deserves your attention, your energy, your capital, independent of what you've already spent. This is not callousness. This is freedom. The investor who can look at a losing position and say, "The price I paid is not a reason to stay." That investor is not cold or emotionally detached. That investor is clear. And clarity in markets is one of the rarest and most valuable things in the world. Let's bring this home. Your brain is not your enemy. It evolved to protect you, but it evolved in a world where losing resources was genuinely dangerous, where a mistake meant real physical consequences that couldn't be undone. In that world, the instinct to hold on, to not give up, to keep fighting for what you'd already invested, that instinct kept people alive in the stock market. It destroys portfolios. Understanding the sunk cost fallacy is not about becoming emotionless. It is about becoming aware of when the past is making your decisions for you, aware of when pain is masquerading as logic, aware of when holding on is really just a way of avoiding the truth. The truth is simple. Even when it is hard, what is gone is gone. What matters is what you do now. Your worst investments are the ones you can't let go. Not because of what they cost you, but because of what holding them costs you next.